rest of you. Welcome to our inaugural quarterly market update. Thank you for joining us. While this webinar is open to guests and the public at large to invite them to explore our unique approach to wealth management, we have curated today's content to be of interest specifically to our valued clients at New Outlook Wealth and SKYE Wealth Planning. My name is Michael Van Leerp, and I'm the president and founder of New Outlook Wealth and president of SKYE Wealth Planning. Our two Winnipeg-based financial advisory firms are proud to launch this new series of quarterly market updates featuring timely, relevant, and insightful commentary from some of our top investment management partners. Indeed, I'd like to specifically welcome Todd Johnson, Chief Investment Officer of BCV Asset Management, Brent Smith, Chief Investment Officer of Kinsted Wealth, Oliver Yoon, Head of Harness Investment Management, and Sheila Wilson-Cole, Portfolio Manager and Director of Equity Research at Cardinal Capital Management. Thank you all for joining us today. And now let's get down to business. So the first section of our panel today will be a series of quarterly updates. Each of you have about 5 minutes to go through your formal commentary around the first quarter of 2023, each of about 5 minutes each. Let's try to stick to that as closely as we can. And then we'll move right into the roundtable panel discussion with a series of questions that I have to pose to all of you, of which I'm sure you have wonderful commentary to share with all of us. So with that point, I'm going to pass the baton right away to our first presenter, who's going to be Todd. Thanks, Todd, for joining us.
Thank you, Michael. Sorry, I was a couple minutes late. I was on the Teams link and I'm like, something's wrong here. So my apologies. So yeah, so I will solve that problem. My apologies. So once again, thank you for joining us, and appreciate. Thanks, Michael, for letting me speak here. So in terms of what we've seen over the last 5 minutes from BCB's perspective over the last quarter here, we've seen markets rebound a little bit and positive. Our North American equity mandate in terms of Canadian US stocks is up about 6.7%, and then even fixed income is up 1.8% in the quarter. So those are kind of positive markers in terms of what we've seen over 2022, which was a tougher year in aggregate. So a reasonable start to the quarter. However, it was a very eventful quarter. We've seen some U.S. bank chaos, which reminded people, I think, a little bit of all the fun that happened in 2007, 2008 in a small sense. We've seen the impact of the anniversary of the war in Ukraine. And then we still see a persistent interest rate cycle. I would say those are the three major factors that they impacted, I think, the quarter in terms of how people are prospecting and how we're trying to position portfolios moving forward, digesting those factors in terms of trying to make wise investment decisions. So what did we do? What did we think? We try not to make obviously short-term kind of decisions. We try to find high quality opportunities looking out kind of 3 to 5 years. And so what did we want to do? What did we do? We took a bit of advantage of the banking chaos, and we added to our position in Bank of America. So we thought that made sense, selling a position that we had done reasonably well. Cisco, which is we hadn't held for that long, but had pretty good earnings, and we think the business is kind of we still have optimal outlook for Cisco, but the Bank of America in this kind of drawdown and opportunity set, we thought we wanted to increase our positions there moving forward. And also added to a core position in bank and Brookfield Asset Management, Brookfield Corporation, sorry, selling a utility for us in the position, really for tactical reasons, meaning that our opportunity set from Fortis versus Brookfield Corp, we think is really attractive. Lots of some asset managers in the quarter and last year have been discounted a bit, and so we see a good opportunity moving forward. One other trade we did, which was we unloaded our position in Manulife, which is a long-term holding, attractive dividend, but very bumpy and kind of uncertain growth outlook on earnings. They are growing the dividend. We are attracted to them, but we had a higher confidence interval that CP Rail, with its acquisition of KCS, was a better longer term hold in terms of seeing that business. And there's only so many railways in this North American continent we have, and that management team we think is the top notch, and we think we can compound more value versus owning an insurance company, which we had less confidence in its ability to grow, given a lot of the noise that happens when you have a big balance sheet and lots of unknowns. So So anyway, that's what we did in the quarter. Continuing focusing, on the longer term. Obviously, digesting continually, waiting for the eventual end of the interest rate increases and the rollover of inflation. Not certain exactly how fast, and of course the widely predicted recession that eventually comes. Who knows how deep and how shallow? But we remain confident that our portfolio of fixed income and equities can navigate it, and we'll look back 3-4 years from now, and I think we've been happy how we position portfolios. So with that, hopefully I didn't go over too many more 5 minutes, but I can roll to the next person.
Perfect. Thanks, Todd. That's awesome. Brent, on to you.
Yeah, I may have, let me see, I did prepare something. I'm not sure if you, let me see, can I share my screen?
You should be able to, yeah.
Yeah, I have no idea how to use this, so.
At the bottom of the screen, oh, there you go.
Sorry, do you see that?
Yeah, we see your PowerPoint.
Okay, cool. So, yeah, we've got our business is mostly pool based. So I thought, I know most of the other folks on the panel are going to be talking about equities and fixed income. So I thought I would focus more on our pools that have predominantly non-public exposure. So the Kinsted strategic income pool is made up of things like private credit and mortgages and infrastructure debt and music royalty trusts and bank loans, anything that's got some kind of income. They're income oriented. So for the quarter, it was up 1.7%, which it's definitely lagged the Canadian bond universe, which was up by probably about 140 basis points. But over the past 12 months, up 7.6%. I'm just going to put my timer on because I like to talk. So we're actually quite happy with the performance of this pool longer term. It's got close to a 4-year track record. As far as what we did within the pool, we made a couple of additional commitments to some larger private capital firms down in the US, predominantly private credit. We're big fans of private credit, especially in this environment where the floating rate has gone from about 0.05 a year ago to close to 5% today. So, and yield spreads over that are even higher than they were a year ago. So we really like private credit. I think what's noteworthy about this pool, while it certainly underperformed the Canadian bond universe, since its inception, it's got probably only about 25% of the volatility of the Canadian bond universe. So we're quite happy with this one. And then on our real asset pool, which is, I'm sure most of you probably are familiar with it, is going to be private real estate, private agriculture, timberland, and private infrastructure. Private infrastructure. So this pool was up 2.3% for the quarter, up 7.1% over the past 12 months. Most of the performance really came from our private infrastructure. Private infrastructure has been doing really well in a higher inflationary environment. A lot of the private infrastructure holdings have, government guaranteed contracts or very long-term contracts that are tied to the rate of inflation. So they tend to do quite well, regardless of the economic environment we're in. I would say that our agriculture timberland has been somewhat of a drag to performance over the past couple of years. While we have had some that have performed exceptionally well, most of our foreign ag exposure has underwhelmed us. I'd say a big part of that is due to some of the foreign holdings. Our managers do not hedge performance, or hedge the foreign currency exposure. And given how strong the US dollar is being relative to some of these, South American currencies, that's had a bit of a drag on performance. But overall, we like the positioning of the portfolio. Haven't made any new commitments so far. Our largest commitment, once eventually all of that capital is called, is a Brookfield Global Transition Fund. And if you're not familiar with private investments, especially say infrastructure and real estate, a lot of the returns tend to be back-end loaded as it takes time for them to get fully invested. So we think that there's a lot more in the pipeline for returns longer term, given especially on the infrastructure side, which we continue to look to increase our exposure there. Strategic growth pool. Strategic growth is a pool that's got a lot of private equity, venture capital, both primary funds, secondary funds, very big fans of PE secondaries. We also have anything that we think can deliver kind of, mid double-digit returns over the long term, collateralized loan obligations, distressed debt opportunities. It's gonna find its way into the strategic growth pool. Obviously, in a risk off environment over the past 12 months, underperformed. Long-term performance has been quite strong for this pool. Really like really like this pool for over the longer term. If you look at vintages of private equity or venture capital, historically the vintages launched during this type of, weaker economic, if you want to call it a weaker economic environment, or weaker or volatile environments, those vintages historically have performed the best. We've got a lot of commitments, especially on the PE secondary side, that has not been called. And I know our managers are buying things at, 40-50% discounts right now. So I think that over the longer term, next couple of years, I think performance will be quite strong in this pool. Always looking at new opportunities. Recently made a commitment to a legal opportunities fund, which targeted returns are pretty spectacular on that one. So that's where we are today. I guess we can talk about our view on the economic or the market environment after our next two panelists chat. So thanks, Mike, and I'll hand it over to you.
Perfect. Thanks, Brent. That's awesome.
Yep.
As we're right on target time-wise, so I appreciate that. We'll pass the baton right away to Sheila from Cardinal. So Sheila, it's yours.
Okay, thank you. Thanks for having us. So we're predominantly focused on equities and fixed income to some extent. So as has been touched on to some extent, we saw quite a notable swings in the market in the first quarter. And I guess you could say we had a bit of a March madness as well in the markets with the issues that arose with Silicon Valley Bank and just general concern over the US regional banks. That certainly contributed to some weakness with some of our Canadian bank holdings and the US banks. The Canadian banks that had more exposure to the US, like TD, certainly had more of an impact. With TD, it's also a matter of they have a stake in Schwab. That share price was down. And then, of course, the pending acquisition of First Horizon. We're still comfortable with our holdings overall. And in terms of their US banks, they're all the leading major banks and actually are benefiting to some extent as funds or deposits are flowing to the banks that are deemed more stable. It was interesting to see some major reversals from the fourth quarter. In the fourth quarter, consumer discretionary sectors, materials, they were quite weak, but coming into Q1, that really reversed substantially as funds flowed into some of those more beaten down stocks, such as in consumer discretionary. We certainly saw some of our holdings in that sector do well, including Canadian Tire. And then just looking at the energy sector, that was the one sector that was in negative territory in Canada for the first quarter as the oil prices fell. A lot of the energy companies did as well, in particular the producers. With Cardinal, we're more focused on stable, predictable companies, especially in the infrastructure pipeline space, companies like Enbridge. So they fared better overall with the strong dividend yields that they pay out. That certainly helps support the stocks. And then also notable was the real estate consumer staples sectors. They did quite well. We saw some good quarters and the strength in the industrial and the residential real estate area certainly helped out a number of names in that area that we hold. And those categories do remain strong. So overall, we had a pretty good quarter despite some of the market's volatility. Our Canadian equity, it was just ahead of the index for the quarter. So I think it's just a matter of what's on the horizon in terms of interest rates. Are we going to have a recession and whatnot? So I think lots of items to keep an eye on for the rest of the year.
Perfect. Thank you, Sheila. That's great. And with last but not least, Oliver, pass the baton to you.
I don't know what else I have to say here, but great to be with everyone. I think I share much of the same sentiment that my colleagues here have shared around kind of 2022 being a tougher year, and overall performance in Q1 of 2023 was positive despite some of the bigger headlines that we've seen, which have obviously been unsettling for a lot of us. That being said, overall, we've got some clients in our VCV pools here, and so maybe Todd covered that. So maybe I'll talk more about the purpose investments models that we have here. But I think the performance on the purpose side has been fantastic in Q1. On a balanced in our balanced model, I think clients got 4.1% return, and on the growth side, 5.1% return, which I think was relatively very positive compared to what we've seen in the markets. And certainly from a fund positioning side of things, equities. There was definitely March was a tougher month, but certainly leading up to that, I think we saw some great results there. Defensive positioning with dividend equities was also quite positive on the value protection side. But I think we've definitely seen some mixed results on that side over the quarter. Fixed income, I think I'd say we definitely extended our duration, which was a significant factor in our performance on the fixed income side. And obviously, there's lots of talk about central banks and the hawkishness around the narrative on the Fed side, which has contributed to that. But overall, we had fantastic performance on our fixed income. Last but not least, we do incorporate what I call liquid alternatives into our portfolio to kind of offset some of the positive correlation that we've been seeing in the equities and the fixed income side of the portfolios. And one thing to note we've seen is commodities obviously have had a nice rally here. We had quite a bit of positioning in gold relative to where we are normally. And with kind of the shoot up in price that we've seen, we did make a couple of tactical calls to divest out of gold and just bank some of those wins. On the fixed income side, we did make a change earlier in March where we got out of some of the high yield bonds and relocated some of that to corporate bonds as well as cash, where obviously the cash yields have been very, very attractive. So maybe I'll wrap it up there.
Thanks, Oliver. That's great. So that's a nice overview of what has been going on for the first quarter of 2023. What I'll do now, guys, is go right into our roundtable or panel. And it doesn't have to be in any particular order, but I have a series of questions we'll go through, and hopefully they'll generate some good discussion. So the first question is touches on certainly things you've already mentioned somewhat, but I'd like us to go a little bit more in detail. So the question is, has 2023 started out largely as you anticipated, given your insights and the forecast that you had nearing the end of 2022? And what has surprised you so far? So that's the question, and I'll start with you, Oliver.
Yeah, it's a great question, and I'm sure some folks at the investment committee have different views, but I'd say overall, I think we've been pleasantly surprised at the overall performance in Q1 that we've seen, obviously after a tough year in 2022. And so on that end, markets have been relatively resilient. We do think risk remains, and obviously there's lots of talk about recession, and obviously the inflation is something that the Feds are, the central bankers are looking at very closely with respect to what they do on the interest rate side. So I think I think definitely we're going to celebrate a strong Q1, but certainly remain cautious around kind of where the rest of the year is going to take us.
Perfect. How about you, Todd? So what would you say were sort of based on the insights you guys had, forecasts coming into the year, what has surprised you in particular? I believe you're muted, Todd.
Thank you. Sorry. I guess two things maybe I would highlight. I think the Silicon Valley Bank and the idea that a bank in the U.S. would manage its duration risk in such a relatively reckless manner, that just surprised me. I just that fact that you could see a bank just vanish. We all see banks kind of fall, but usually loan losses and problems and loan losses that cause the flight, not just a pure liquidity and balance, capital mismanagement from the CFO and treasury. So yeah, I think Silicon Valley vanishing surprised me. And then the second thing is, I would say, I always thought the inflation rollover would happen a little bit faster. I think inflation has been stickier than I thought. I thought anniversary of the war, have we seen that? We would have saw that would be kind of the peak of like that. But I think I was probably a little ahead of that. I think I still believe that, and that's going to be, inflation's going to be decelerating, but I would have thought it would happen a touch quicker. So those are the kind of two things, when I look back at over this quarter that, that have happened, that have been notable.
Cool. Good stuff. How about you, Sheila?
Certainly the year started off a lot stronger than we were anticipating, given there are a lot of risks that are still outstanding. So it's touched on, the inflation is still fairly elevated, trending down, but we've got a ways to go. We don't know if we're at the end in terms of interest rate hikes, especially from the US Fed. The ECB has stepped in and hiked. So I think there's still a lot of uncertainty. So to see the markets move so quickly was certainly notable. And then just kind of drilling down into on the US side of the border, the S&P 500, it certainly had a very good quarter, but when you drill down into what was doing well, it's really the mega cap tech driving that. So we look at just the equal weighted index, it's up just shy of 3% versus the 7.5% headline number. So I think that's kind of interesting to see that we didn't see the breadth across the board in terms of market performance.
Interesting. And Brent, I mean, you guys are doing things a little bit differently at Kinsted, but what would be based on the forecast that you guys had heading into this year, what surprised you?
Yeah, I mean, whenever you're talking about forecasts, you don't want to hear a forecast on global agriculture or infrastructure. Yeah. But when it comes to the public markets, quite surprised. I think similar to everyone on the panel on how well the public equity markets have done, especially when you look at the fastest rate hikes in history. You've got quantitative tightening, no longer quantitative easing. You've got money supply contracting. You've got lending standards that are really tight, have really tightened up. If you look at it, about a year ago, kind of, we started to see rate hikes about a year ago, and it tends to take about 18 months to 2 years before those rate hikes starts feeding through the whole economic system. And so really surprised about the resiliency of the public equity markets. Our view is that eventually we are going to see a recession, and that earnings haven't really been impacted to the degree that we've seen so far, but we think that as those rate hikes, those massive rate hikes start flowing through into the economic environment, we're going to see earnings impacted, and still think that there's more downside for the public equity markets.
Interesting. All right, thanks, Brent.
Mm-hmm.
So on to the next question, guys. So we've touched on this a little bit already. So we know the rate of inflation is no longer accelerating as fast as it was, but it is remaining quite high, stubbornly high. How has this affected either specific companies owned in your portfolios, or entire economic sectors, or even specific investment strategies? Where has the inflation factored into all of these, or any of these effectively? And we'll reverse it. Start with you, Brent.
Yeah, when you look at rate hikes and inflation, obviously inflation has led to higher interest rates. the economy, both in the US and Canada, is still very resilient. Again, I think that that's going to soften at some point. But what's really helped our portfolios is private credit. Private credit is predominantly floating rate. And as I mentioned, SOFR, which is the floating rate, which is overnight lending rate, about a year ago was 0.05 and today is close to 5%. But not only is that floating rate has gone up, but the spread of private credit over the floating rate has actually increased. There's better covenants. And now a lot of private credit you're looking at, SOFR plus 600 to 800 basis points. So private credit and gross yields are anywhere from 11 to 1400 basis points today. So that's really had a big positive impact on our private credit holdings.
Oliver, how has inflation affected things?
Yeah, it's a great question. I think undoubtedly inflation is obviously causes central bankers to raise interest rates, and I think that's really brought kind of bonds back to life in terms of what they're supposed to do and the yields that they're providing in portfolios. I think for a long time, I think we were all asking, where do we find yields? Where do we find yields? So you go down the credit quality, or you start looking at other alternative strategies. I think we've kind of slowed down on that kind of thinking a little bit as an industry, and certainly that end, I think fixed income side has become a lot more attractive. We're looking at alternatives in a different lens a little bit now. And I think this was, the alternative lens was always meant to be a bit of a dynamic lens for us. The way we think about it is, when you look at a stocks and bonds portfolio, what is it missing? What is it not providing? And we try to accommodate some of those missing gaps in a long only portfolio with our alternative sleeve. And to that end, I think we've definitely pivoted our focus a little bit away from, yield generating, opportunities to ones that it's more, inflation protection and with real assets, and that's where we've really started to see our shift in our portfolios.
Makes sense. How about you, Sheila, with Cardinal?
So in terms of our portfolios, we tend to invest in companies that generally they can deal with inflation and are able to pass it on typically. So for example, the rails, and we've touched on that sector, they're able to pass on inflation every year. We have one utility still in that they have mechanisms in place to recoup the rising prices. So, generally we do see our portfolio able to withstand some of the inflationary impacts. Not everything is insulated, of course. I think in the retail space, the retailers were generally able to pass on those costs, but we're reaching a point where the consumer is just no longer willing to buy, and we're seeing some softening in terms of consumption there. So that's going to get tougher for the retailer side of things, but there certainly are some more levers that companies are able to pull. We're seeing supply chain kind of work its way out, so that's going to be an assist as well. Transportation costs are declining, and even on the labor front, most companies are finding it a bit easier to hire and also retain staff. So there are some things that companies are able to do on the cost side of things, but I think in terms of some areas being able to just raise the price is going to become a lot more difficult. So I don't know if I'd be buying a lot of grocers at this point in time. I think it's going to be in particular for them challenging to continue on that track.
Agreed. Very good insights, Sheila. Todd, what would you say overall from the, and it should be noted that today, I think it was today, the announcements regarding the inflation rate has slipped to 4.3, still high, but definitely much lower than it was even 6 months ago. So it's definitely trending in the right direction. But to the point, the overall point, Todd, yeah, how has it affected the portfolio? How has it affected companies that you guys own, and so forth?
Well, declining inflation helps us all in some sense. It's, lowers the discount rate. So I think a bunch of us were at the CFA dinner in Winnipeg, and former Bank Canada Governor Stephen Polo's had a pretty dovish view on where inflation is going in Canada and generally. So we'll see how that happens, that plays. But yeah, I mean, you just have to manage through it. We can't control inflation. We just got to manage through it. And yeah, you're getting paid definitely in fixed income a lot more, and spreads are pretty good. We see opportunities sometimes in some of the property bonds that are some stress out there in terms of office properties and refinancing, and a lot of things happening there. So we think there's a few opportunities there. On the equity side, yeah, longer term, hopefully declining inflation is going to revert to the norm, somewhere between that 1 to 3. I'm probably closer to 3. But in terms of companies, yeah, like Sheila said, we like companies that have pricing power that can pass it through. And one company that we've added over the last year and a half is kind of on that theme of consumer being squeezed, and that's Dollarama. Certainly not an inexpensive stock, but it's a business that grows, and when people need low cost stuff, it's a leader in Canada. So there are ways to kind of play that kind of squeeze, unfortunately, on the middle class, lower class consumer that it can compound value for shareholders. So yeah, in general, it's not a great environment for sticky inflation, but yeah, we're managing it.
All right. So the third question, guys, is regarding the labor market. So the labor market remains very strong in Canada, despite the challenges of higher than average interest rates. That puts various strains on businesses in the commercial sector. Are good employment numbers hiding underlying problems that you're still preparing for? So with that question, I pass it off to Sheila to start.
Okay. No, it's a good question. And, I would take a bit of a longer term view on the labor market. I think we actually could run more into the problem of having a shortage of people, like over the medium to the long term. Just from a structural perspective, we're seeing a lot of baby boomers retire. And that means, of course, there will be jobs to fill. Immigration's helping to some extent, and I suppose that might lead to the question of, might we see the labor pool increase too much and see rising unemployment? But I think there's some circularity to keep in mind on that front, because as people become employed gainfully, and as a lot of people are also getting the opportunity to step into a higher wage job, and that does lead to more consumption and spending, and ultimately growth and further demand. One of the questions is, do we have the workers, I think, in the right areas? So healthcare is one sector that certainly pops to mind. It seems like there's a lot of demand and not the people to fill those jobs. So I think there's some work to do in terms of making sure people are skilled to fill those vacancies. And then just lastly, one of the questions certainly that we talk about is companies are really struggling to hire and fill positions over the last couple of years. Are they going to be quick to letting those people go now that they have hired them? Some areas, such as in technology, potentially or did overhire, and they're kind of right sizing at this point in time. But I think there's a lot of other businesses that aren't necessarily looking to let go of that staff so quickly.
Perfect. Thank you, Sheila. So pass that to you, Oliver. What would you say are some of the underlying potential problems that a strong labor market might actually be casting a shadow over?
Yeah, it's a good question. I mean, I think I share a lot of the sentiment that Sheila shared. Certainly, I think when it comes to tech companies, the fact that they laid off a bunch of people, I think is actually a good thing. Just because the pace at which they were hiring and growing was, like it was bubble-esque in a lot of ways. And so the fact that they're hiring, stopped hiring and started shedding, I think certainly from a Canadian marketplace, I know a lot of our tech talent was actually leaving to the States with better comp and all of that. So I think in that end, we retained better talent here. And, certainly, me being affiliated with a technology company in purpose here, I can tell you that firsthand with respect to our recruitment efforts. The other side to it, I think, I think obviously, central bankers are looking at the unemployment rate as well, right? And certainly, I think that plays a role in what they do with interest rates. And the thing that's been holding them back from all this is that employment rate has been steadily great, right? So it's been a bit of an interesting spin on that, and curious to see where they go from here. But I can only imagine they're scratching their heads a little bit in terms of what to do as well on that side.
All right. What about you, Todd? What are your thoughts on this situation?
Well, I think one can say that having a low unemployment rate is a good thing for society in general. I mean, it's we want that. I would concur as well a little bit with Oliver and Sheila. I think I think companies they may face some margin pressure if things slow down, because they don't want to get rid of people, because it's hard to get the right people. And I think that's that just could be a challenge for companies. I think they just you'll be pushed and focused more to be more efficient and find technology to be able to kind of utilize and grow your business. But yeah, I would I think I would say as well, from our perspective, we've done a lot of hiring, and we certainly wouldn't want to be losing people and having to retrain and such like that. Would rather so if I'm like an average Canadian company, I would be willing to take the margin hit, because I want to keep the people, because it was I don't want to go through a pull. So in general, it's probably good for workers and maybe not so good for companies. But if you look back in the last 20 years, I think capital and businesses have taken a bit more of the economic pie than labor. So I think this shift is probably healthy in the long term.
That's interesting. Cool. God. What about you, Brent? So if you look at it from the lens of, well, from your particular portfolio management style, private equity and private credit in particular, does the labor market tightness have any particular concerns for you? Obviously, it's good news in many regards, and that continues. But how would you?
Yeah, I mean, we tend to look more at the U.S. labor market. I mean, unemployment is just so low in the US, and it doesn't matter. It feels like it doesn't matter what the Fed is doing, raising rates so dramatically, that labor continues to be very, very tight. I think there's 2 jobs available for every unemployed person. So it's tough. But at the end of the day, I think you're just bucking history if you believe that employment at some point is not, or that the unemployment rate is not going to pick up. I think your view on the economy will dictate your view on the labor markets. And our view is that these rate increases will eventually have an impact on business in the US, and there will start to be more layoffs. I'd be shocked if it doesn't happen. Because it's basically, you just kind of follow history, and there hasn't really been a recession, I don't believe, in history that didn't coincide with a big jump in the unemployment rate. So it could be a relatively mild recession, but at the end of the day, it will still be a recession. I think that we will see a pickup in the unemployment rate in the US. And I mean, it should occur in Canada as well. To what degree, who knows? But it will happen. I'm pretty confident.
I think also that there's a fairly common knowledge that the notion of the labor market trends and stuff, and employment numbers in particular, are considered lagging indicators, not leading indicators. So they tend to lag what's actually going on behind the scenes. Yeah. So they're not a great indicator or a great way to as a litmus test of how the economy is performing necessarily. It's
You're correct.
I just want to caution folks around that too. Like, it sounds good and it's very good and the numbers have been good, but that's why the question around underlying problems, like what is it hiding, right? So on to the next question, which kind of is a follow-up to what we've just been talking about, is the ugly R word. Has been thrown around a lot like it was a certainty, yet that seems a little less likely now. I mean, the numbers, depending on what you're looking at, could be hawkish, dovish about this, whatever. Recession or not, companies and entire sectors still earn money and profits drive portfolio performance. So what emerging trends, either macroeconomic, geopolitical perhaps, concern you the most in the coming 6 to 12 months? So that's the big last question for you guys. So I'll start with you, Todd.
Okay, macro or geopolitical? I would say I would be worried about both of them. So geopolitical, I think how the Ukraine war ends, if it doesn't end, how that I think that obviously could escalate if you see any sort of nuclear weapons used there. I think markets would react negatively because you could see escalation. You don't know what the West is going to do. And of course, who knows what's going to happen with China and Taiwan and what the US would do there. So those are just, you can't get away from them. You have to invest, you have to keep managing. to me, a negative scenario is still probably a low probability on both of those, but it's very consequential, right? If it's a negative scenario, very consequential if that happens. So low probability event. It's like betting on the Jets to win the Stanley Cup, it's possible, but if it happens, it would be consequential for Winnipeg. It'd be very consequential for equity markets. So macro, I would say just the yield curve, like it's banging you on top of the head that, the rate cycle and the idea that we can pop rates up this fast and that we're not going to have, a recession, 6 months from now. Like we haven't seen it yet. Maybe we're here. It doesn't, we're not there yet, but the idea that you can't avoid it and it's coming yet you don't see it. So those would be the two things that, that you have to deal with, manage, and try to make smart decisions with.
Perfect. How would you take it? What's your take on it, Sheila?
Well, certainly all the indicators are that we will see a recession at some point, whether it's later on this year or into 2024. Even if we do see a soft landing, having low growth that's in that 1% range is still going to feel somewhat recessionary to a lot of people. And as you touched on, after we've been talking about it for so long, recession, when it's going to happen, how severe it's going to be, it does feel like, okay, let's just rip the Band-Aid off and get it over with so we can get on to the other side of things. But, we often like to talk about like recessions. I mean, they're a normal part of an economic cycle, and they do kind of let some of that pressure out of the economy. So, in terms of our portfolios, we just focus on companies that can weather a recession. They've done it in the past, they'll do it in the future. So that kind of gives us comfort on that front. I think, Todd touched on a lot of the issues that we're certainly concerned about on the geopolitical side, the US-China relations, and what happens with Ukraine. It seems like that conflict is just frozen. It's going to be with us for, quite a while. And then I think just on the interest rate side, is the Fed going to hike again? Are they going to continue to raise rates? We think the market might be, perhaps a little ahead of itself and thinking we get a cut by the end of the year, but I guess we'll wait and see.
Right, that's perfect. Thanks, Sheila. And before I go on to the next one, I'll invite our attendees and guests to submit questions in the question Q&A section at the bottom of your screen. So if you want to type in questions, and then once we're done this final point on our panel, we'll go into the Q&A and I'll read the questions and you guys can answer them. So just wanted to remind everybody to feel free to enter their questions. Brent, pass it to you. So given the situation, risk of recession, where do you think things are headed?
Yeah, I think, well, let me touch on the geopolitical. I mean, you can't manage money based upon what ifs. I mean, there's always, it's the geopolitical that brings the potential black swans to the front, and you can't prepare for those, right? Now, after the fact, of course, people are going to say, yeah, you should have known that was going to happen. But I mean, those are things you can't really prepare for. I think you can prepare for macro events. Is there going to be a recession? I'd be shocked if there isn't one. And yeah, like I said, I'll just reiterate what I said before. Fastest rate hikes cycle in history, quantitative tightening, money supply contracting, lending standards are being tightening. So all of that to me points to a recession. And yes, it takes, like I said, about 18 months to 24 months before the rate hike starts impacting the economy. And we're about 12 months into that, 12, 14 months or so into that. What I would point, since 1929, I believe, there hasn't been a recession that we didn't see a corresponding drop in the public equity markets. And typically the average, this is typical. I mean, we could be different this time. I hate using that phrase, it's going to be different this time, but the average market bottomed 9 months after a recession begins. So if you do believe that a recession is some point down the road, the bottoming of the stock market is on average, again, is sometime 9 months after the beginning of a recession. So to put that in perspective, if you think a recession is going to happen in the beginning, and we only know it after the fact anyway, but January 1st, 2014, well, typically markets have bottomed 9 months after that. So you're looking into September of 24. So those are just some scenarios that I think investors should take a look at if they believe that, in fact, a recession is going to occur. I think it will. As a firm, we only have probably about 25% public equities in our firm, and we've become much more conservative in the management of those because of those macro factors out there.
So that's awesome. Thanks, Brent. And I just want to add, for the benefit of our audience too, that we throw around these terms like recession like candy, but the truth is that you have to have 2 quarters of negative economic activity recorded by Statistics Canada to qualify officially as a recession. So there could be lots of recessionary type activities or things happening around us. It doesn't necessarily mean it actually is a recession. So it's very interesting. And even to that point, that is also a lagging indicator, because tracking that economic activity is not, live 24/7. It's something that requires a lot of obviously data collection. So it might be a while before we even know what's happened. And by that point, things have moved on. So Oliver, I'll pass the torch to you, and then we'll get to the Q&A right away. We're actually quite on time, so I'm impressed.
Yeah, that's great. I won't take up too much more, but one thing I do with clients, I think recession obviously gets some people nervous, but at the end of the day, it's not something we can avoid. The market cycles are the market cycles. It'll repeat itself and do it over and over. And as long as we establish an understanding with the client that we're going to stay invested and not be pivoting in and out of the markets, which is what we always do with clients, whether it's a recession or not, I think frankly, it provides us an opportunity to show our value in active management and identifying those industries and players where we are going to see quicker outperformance out of those tough areas. And to your point, Michael, no one really knows when they're in the recession. It's always an after the fact thing. And so all the more, I think, we de-emphasize, the fear of recession on our end, and how we talk to our clients and say that, we're best positioned. The 2 things you can do is stay diversified, so that when we do see pullbacks, it's saturated. It's not saturated too much on one side of the portfolio, and the other side is, we stay liquid. We invest almost exclusively in publicly traded securities on our side, and it gives our portfolio managers at Purpose Investments kind of the ability to go in and out of markets, in and out of sectors quickly as we see things develop. And at Harness, we develop our expertise on making sure we can apply those changes across client accounts in the thousands at once, and give clients all the same price, and ensure that their money is following what we call an institutional mandate at all times. Lastly, on the emerging trends, I think Brent alluded to it, but the one thing that does kind of give me a bit of concern is what happened with Silicon Valley Bank. I think it's highlighted kind of the crack in the market we saw when interest rates go up as fast as they did in 2022. And, I'm curious to see, are we going to see more of those types of cracks in the market? I think markets want to believe that it was a one-off risk where the treasury people there couldn't, do their jobs very well. But I guess we'll see, just based on the number of regional banks they have in the States and such, are there more cases like this that we're going to see over the next few months?
Perfect. So we do have a question from our audience, and we might get a few more as time goes on. So the first one is, and any one of you can take a crack at this, where can you hide in the markets if there is a recession? So if the baby water is thrown out with the bathwater, like in 2022, when both the equity and fixed income was down, how do you avoid that? How would you treat such a scenario? Any takers?
I'll take that. I think there are a number of areas within the the whole investment universe outside of the public markets that you can't quote unquote hide. I mean, especially things like infrastructure, or there's even certain real estate areas like multi-residential. You know, we really are big fans of infrastructure. And when I talk about infrastructure, a lot of it is core infrastructure that it doesn't matter what part of the economic cycle you're in, it's still going to do well. Now, unfortunately, a lot of that is privately traded. And yes, you can make the argument that it's just as volatile as public markets, but it's just not traded on the public markets. But and there's, you know, even private credit. While I recognize that in a recession, economic or businesses, it's more difficult for businesses during recessions. I think as long as that private credit manager is dealing with some high quality firms, they're taking that into account anyway. They're taking into account, is this business going to be able to cover its interest payments in this kind of environment and so on. And so, yeah, there's a number of areas outside the public markets, I think, that you can quote unquote park your money if you want.
Any other insights, guys? Todd, Oliver?
I might just jump in there. Like in terms of the public markets, certainly with Cardinal's approach is, you know, when you're focusing on high quality companies that have a good balance sheet and that pay that dividend that's growing over time. You know, we certainly talk with our clients a lot about the share price might decline to some extent. We tend to offer downside protection, but on the flip side, you're getting that dividend. That dividend income keeps coming in. Generally, it's growing. We've seen that over the first quarter. We had quite a few dividend increases. So that is, you know, somewhere where you can look to in the public equity markets. And then just on the fixed income side, with the rates rising, there certainly are some opportunities to put some money to work there, especially if clients have more shorter term cash flow needs coming up.
Perfect.
Yeah, I would just add, it's an interesting question and one we get all the time. I always tell clients, you don't need to do the hiding. Like the time itself will actually do the hiding for you. Like in the sense that, you know, if the client has a 20-year runway or a 10-year runway, and they see a 20% dip today because they were super aggressive in their portfolios, you know, as long as you're not really pulling out that money over the next 20 years, you know, you're going to look back at this point in time. You're going to zoom out in your graphs and say, oh my gosh, I remember how I felt in that point in time. But really, it's just a steady uptrend overall, right, over a 20-year period, 10-year period. And so I think time does that for you. Certainly, if your time horizon is literally like next year or 2 years you're retiring and you see huge dips in your portfolio, I think, you know, I think then we've got some accountability to take as advisors to see what we've done wrong here, right? And you know, I think that's how I'd look at it. You know, I always try to bring it back to, you know, what's actually the plan for you and for the client, and you know, we're going to do our jobs, and you know, I think we've structured ourselves well to make sure we're doing best that we can with your money. But certainly, you know, I think everyone on this call will agree, we don't know which sectors are going to do well over the long term, which sectors aren't going to do well. We're going to take our best guesses, but at the end of the day, we pivot as we see changes in the market, right? And so, you know, I think you want to give yourself the best chance at doing that, and I think it starts with kind of your financial plan and knowing kind of how much time you have.
Definitely.
And I'll, I guess, be the last guy to end it here, but I would say that 2022 was an interesting year. We had rates really low. We had monetary policy way too loose. We had accelerated inflation. We had government money thrown out. Like going into 22 was a different environment. Right now, yeah, we have had some challenges. Rates are higher. I would say the investor wants to hide now. There's a higher risk of being wrong now. I mean, Brent's right. Markets usually bottom a bit more closer to the day of the recession, but they do bottom and they move up. So I would say that someone looking to hide now, if you didn't hide at end of 2021, which I could say, I come more of the rationale, this is maybe a time to park money. This is, you know, there's less opportunities now to park money. I mean, even you could get paid 5 points, but I would say that the person that's asking that question, I would ask them how well they've timed markets over the last 10 years. And if they haven't, why are we doing it? Why we keep doing it? You know, that would be yeah, it would be it's a bit longer discussion, but
That's some great insight, guys. And we're getting close to the end of the hour. What I'm going to do is probably wrap it up, guys. We have no further questions from the audience to handle, but I'm sure the next event that we have like this will have more, and hopefully people will have feel more at ease to ask questions, because there's no harm in doing that. But we will wrap it up. I just want to thank you all for your time today, to our panelists, Brent, Todd, Sheila, and Oliver, and especially to our clients and guests who carved out time in the day to learn about the current state of the Canadian investment environment. Our next quarterly update is scheduled for July 19th at 12 p.m. Central Time. Make sure you register and join us then. I would also encourage you to forward this invitation to a close friend or family member who you may feel would enjoy hearing from this obviously great team of experts in the portfolio management space in Canada. So with that, I wish you all a wonderful rest of your day, and thanks once again.